The silver price you are re-seeing is the polite version. India just printed an $8 physical premium that the paper market can negotiate with. That's the conflict right now. One screen says calm, while the street invoice says pay up. And the hidden mechanism most people are missing isn't a rumor, and it isn't T vibes. It's a funding and policy squeeze that can make a local premium go vertical even when the world thinks nothing changed. Stay with me, because by the end you'll have a simple checklist for the next week or two. The one level that changes the math, and the cleanest way to tell whether this is a controlled retest, or the kind of continuation move that gaps on you when liquidity thins. Because an $8 premium over COMEX isn't just a markup, it's a stress flare. It's what happens when real metal, deliverable, landed, paid for metal, suddenly becomes harder to source at the exact moment buyers don't want to wait. And the reason that matters is simple. Premiums are where price discovery goes, when the headline price is too blunt to capture the actual constraint. The mainstream will frame it like a quirky India thing, like a local distortion you can ignore. But the market doesn't hand out $8 distortions for free. A premium is a message, and it's written in the language of pipelines, timing, and forced behavior. Here S, the first shift you need to make. Stop thinking silver up or silver down, and start thinking silver available or silver rationed. The paper market can create exposure with a click. The physical market can't create atoms. It can only move them, finance them, insure them, clear them through customs, fabricate them into the form people actually buy, and then deliver them. If any one of those steps gets pinched at the wrong time, the premium is the pressure gauge that snaps first. And that's where the real pressure starts. So what does $8 over COMEX actually mean in the real world? It means a buyer in India is paying spot plus an extra 8 just to get the metal in hand locally. After all the friction, all the taxes, all the logistics, all the I need it now urgency. In a normal, sleepy market, those premiums don't behave like that. They wiggle, they breathe. They reflect routine costs and dealer margins. When they jump, it's because something in the system stopped behaving routinely. But that's not the part that matters. The part that matters is why it jumped now. Not last month. Not after some random tweet. Now, into month-end positioning, into a delivery and roll window where futures liquidity gets thinner than people admit, and into the countdown for India's February 1st budget, when policy uncertainty becomes a tradable risk. Markets don't just move on data. They move on deadlines. And deadlines force action. A buyer who might wait 2 weeks in a stable environment does not wait 2 weeks when a policy headline could land in 4 days. That's the calendar. That's the catalyst. And once you see it, you can't unsee it. Now, before we go any further, let's clear the biggest misconception that gets retail investors chewed up in moments like this. A premium spike does not automatically mean global shortage tomorrow. It means local tightness today. It means the local market is paying to pull metal forward in time, paying to collapse the weight. And the key word is time. Premiums are often less about quantity and more about timing and confidence. If people believe tomorrow's cost might be higher because currency moves, because duties change, because banks tighten financing, then today's premium becomes the price of certainty. And certainty is always expensive right before a deadline. This is why the dismissive take, local noise, is so dangerous. Yes, local markets can distort. But when the distortion lines up perfectly with macro pressures and policy catalysts, you don't ignore it. You interrogate it. Because what a local premium really reveals is where the global system can instantly arbitrage away the difference. If you could simply buy cheap metal somewhere else and flood it into India overnight, that premium would be gone. The fact it's still there, at that size, tells you the arbitrage is constrained, and that means something structural is in the way. So let's talk plumbing. No drama, just mechanics. A physical premium is built from a stack. The benchmark price, the currency conversion, import duties, and local taxes, shipping and insurance, financing costs while metal is in transit and in inventory, fabrication into bars or the form the market wants, and then dealer margin and local demand urgency. Now here, what's the trick? Any one of those layers can change faster than the benchmark price. When people focus only on spot, they miss that the rest of the stack can move violently. And right now, several layers are moving in the same direction at the same time. The next detail is what flips the whole setup. Layer 1. Currency. If the local currency is weakening against the dollar, the landed cost of imported silver rises even if the dollar price of silver is flat. And that matters in a place like India because imports are priced globally, settled in dollars, but sold locally. When the currency slides, importers feel it instantly. They either raise the local price or they eat the loss. They don't eat the loss. So the premium shows up as an adjustment, sometimes as a spike, especially if currency volatility is accelerating. And if currency moves are happening into a policy deadline, the behavior changes from shop around to secure inventory. That's reflexivity in the real world. Layer 2, duties and policy risk. India's budget isn't just a press conference, it's a risk event for anything tied to imports and taxes. If market participants believe the government might raise import duties or change rules, they start acting before the policy lands. That's not conspiracy, that's incentives. If there's even a chance duties go up, the rational response for someone who needs metal is to import sooner. That pulls demand forward. It compresses the window. It jams the pipeline. And you get premiums that look irrational until you remember the market isn't chaos. T paying for silver, it's paying to beat a potential rule change. Layer 3, financing. And this is the hidden detail that reframes the entire story. People assume physical premiums are purely a demand and supply story. More buyers, fewer sellers. But premiums can explode even without a fresh wave of end-user demand if financing becomes threatened. Because metal isn't just a commodity, it's inventory that must be carried. Carrying costs matter, credit lines matter. If banks tighten, if funding becomes more expensive, if the ability to finance imports gets constrained or even questioned, then the people with metal in hand have leverage. They don't have to sell quickly, they can ration supply to the highest bidder. And suddenly the premium becomes a funding premium, a permission to access metal premium. That is not widely appreciated, and that's why most commentary sounds confused right now. Here's how that looks in practice. Importers and dealers typically finance inventory. They hedge price risk in futures while they wait for shipment, clearing, and sale. When funding is easy, the pipeline flows. When funding gets tight, the pipeline constricts. You can have plenty of metal in the world, but not enough metal financed and ready and in the right place at the right time. That's where physical and paper diverge. Paper can keep trading. Physical starts rationing, and the premium is the receipt. Now pile on a fourth layer, positioning and forced behavior. When premiums rise and local prices gap, anyone who is short, either outright or effectively short via inventory hedges, feels pressure. Shorts aren't philosophical. Shorts are a balance sheet. If price rises against them and they're leveraged, they face margin calls. They have to post collateral or reduce risk. Reducing risk often means buying back exposure, covering, and covering into a thin market is how small moves become big moves. This is why you can see a premium spike turn into a self-reinforcing loop. Higher premium lifts, local price, higher price pressures, shorts buyback. Buying lifts price, further higher price makes inventory holders even less willing to sell, and the premium holds or grows because the pipeline can't instantly refill. But that's not the part that matters. The part that matters is what it forces participants to do. It forces importers to front run. It forces dealers to widen spreads. It forces shorts to de-risk. It forces hesitant buyers to either pay up now or risk paying more later. It forces the market to reprice not just the metal, but time, policy uncertainty, and funding risk. That's a very different narrative than silver is up because sentiment. Now zoom out and look at the timing again. Late January is a sneaky period for metals. Liquidity can thin, funds rebalance, month-end flows can distort. And on top of that, you have a very specific India catalyst, February 1st budget day. So you get a situation where the physical market is reacting to a calendar event while the paper market is still debating the storyline. And that mismatch is where opportunity and danger live at the same time. Because if this one level breaks, the math changes. Let's talk about levels without pretending we have magical precision. The key levels in moments like this are usually not some obscure Fibonacci line. They're the levels that change behavior. Psychological round numbers, prior swing highs on commonly watched charts, and, importantly, the premium itself is a level. When a premium prints $8, the question is not, can it go to 9? The question is, does it compress back toward normal, or does it persist? Because persistence tells you the constraint is real and ongoing. Compression tells you the pipeline is refilling and the panic bid is fading. So, in the next week or two, watch 3 things like your life depends on it: the premium, the currency, and the policy tone. Everything else is commentary. If the premium stays elevated, even as benchmark prices cool, that's bullish for physical tightness. If benchmark prices run and the premium stays elevated or expands, that's a stronger signal. The physical market is not letting the paper market off the hook. If the premium collapses quickly, the market just told you the move was policy fear and timing, front running that got satisfied. And that's valuable information even if you're not trading it, because it tells you whether the street is still stressed or whether it just had a temporary spasm. Now, a lot of people will ask, why doesn't arbitrage fix this? Great question. Here's the reality. Arbitrage is not teleportation. An $8 premium is a magnet, yes, but magnets still need metal to move. To arbitrage it, you need inventory in a place you can source, you need shipping capacity, you need insurance, you need financing, you need hedges, you need reliable customs clearance, and you need time. That time can be weeks. Meanwhile, the market is reacting today, so the premium can persist long enough to matter. And that means the local signal can stay loud enough to influence psychology and flows beyond the local market. This is also where the paper versus physical debate gets twisted. It's not that paper is fake and physical is real, it's that paper is a different constraint set. Futures markets are phenomenal for price discovery and risk transfer. But they can remain liquid even when physical pipelines are strained because they don't require immediate delivery in the same way. Most positions roll, most participants settle financially. Physical buyers can't settle their procurement financially if they need actual metal. They need delivery. When delivery timing is stressed, they pay premiums. It's not moral, it's mechanical. And that's why this matters. Now add a supply chain reality check that almost nobody wants to hear when prices are moving. Silver supply doesn't respond quickly. It doesn't surge because people got excited. A lot of silver production is tied to the production of other metals, copper, lead, zinc. So you don't just turn a silver faucet. Refineries have capacity constraints. Fabrication has lead times. And inventories that exist aren't always in the form or location that helps the market right now. Recycling helps, but it's not instant, and it depends on price incentives and collection channels. So short-term tightness is a real thing, even if the long-term supply picture is more complex. That's why these premiums can show up suddenly and then take time to normalize. And there's another twist. Even if jewelry demand is soft, investment demand can surge. Bars and coins behave differently than adornment. They're driven by macro expectations, by currency anxiety, by distrust of institutions, by the desire to hold something outside the system. That's especially relevant when people are watching policy risk and currency moves at the same time. The market can have weak consumer demand and still experience a physical scramble in investment formats because the motivation is different. The next detail is what flips the whole setup. Now let Alrides address the temptation everyone has in moments like this, to turn it into a clean story with a villain and a guaranteed outcome. Don't do that. You don't need conspiracies to explain this. Incentives are enough. Dealers widen spreads when inventory is scarce. Importers front run when duties might change. Banks tighten when currency risk rises. Shorts cover when margin pressure mounts. Funds rebalance when month end hits. None of this requires secret meetings. It requires risk managers doing their job. And ironically, that's what makes the move feel so aggressive. It's not one actor. It's a chain reaction. So let's stack proof the way a skeptical finance brain should. Proof point 1, the premium itself, $8 over COMEX, is the loudest physical signal. Proof point 2, the calendar. Budget day on February 1st is a clear deadline that can reshape incentives instantly. Proof point 3, currency pressure amplifies landed costs and accelerates buy now behavior. Proof point 4, positioning stress. Shorts can be squeezed and covering can feed the move. Proof point 5, supply chain constraints and lead times mean arbitrage is slow, not instant. Proof point 6, the behavior on the ground. Dealers widening bid-ask, availability tightening, delivery times extending, allocation behavior. These are classic companions to premium spikes. You don't need one perfect statistic. You need a stack of mechanisms that all point in the same direction, and right now, they do. But credibility comes from saying what could break the thesis too. So here are the counterpoints, clean and simple. 1, the budget could pass without any duty hike or restrictive changes, and the front-running demand could vanish overnight, taking premiums down with it. 2, currency could stabilize, easing landed cost anxiety and reducing the urgency to pull purchases forward. 3, shipments already in transit could arrive and relieve near-term tightness, compressing premiums even if the global price remains firm. 4, speculative froth can burn out fast. If price spikes attract profit-taking and liquidity improves, premiums can normalize. 5, regulators or major participants can alter behavior around financing and inventory in ways that reduce stress. In other words, the premium is a live signal, not a permanent state. And treating it like a permanent state is how people get trapped. Now let's turn this into a 2-scenario lens, because this is the simplest way to stay sane when volatility is trying to emotionally mug you. Scenario 1 is the controlled pullback and retest. In this scenario, prices cool, the premium compresses, and the market digests the front-run demand. You get scary red candles, headlines about bubble popped, and people who bought the peak feel like the world is ending. But if the structure is healthy, the pullback holds above a key prior breakout zone, typically a major swing high on the benchmark chart, and then the market retests and stabilizes. In physical terms, premiums might dip but not collapse. They might remain elevated relative to old norms, telling you the street is still tighter than the screen suggests. This scenario is boring, choppy, and emotionally exhausting. It's where impatient people donate money to patient people, and that's where the real pressure starts. Scenario 2 is the continuation squeeze and gap risk. In this scenario, the premium remains stubbornly high. Policy uncertainty doesn't resolve cleanly, currency pressure persists, and shorts or hedged inventory positions are forced to de-risk into thin liquidity. That FOS, when you get those air pocket moves, price jumps that done to give you a friendly pullback entry because the market is repricing the constraint, not the narrative. In this scenario, the dip is shallow, the market keeps printing higher lows, and every attempt to fade it gets punished quickly. This is the scenario where people who are late feel FOMO, jump in emotionally, and then get whipped out on the first intraday reversal, only to watch it rip again. This is where volatility is weaponized. And let's be clear, volatility can whip around violently, even if the thesis is correct. That's not a disclaimer, that's reality. Markets love to make the maximum number of people wrong at the worst possible moment. Even a strong, structurally supported trend can deliver sharp shakeouts. So the goal isn't to predict every candle. The goal is to separate trend signal from noise. The trend signal, in this case, is persistent physical tightness and policy funding stress reflected in the premium. The noise is the intraday drama, the headline bait, the influencer's screaming certainty, and the urge to treat every tick like a referendum on your intelligence. So how do you shield yourself psychologically? You pre-decide what you're actually watching. You don't let the market choose your emotions for you. In a move like this, the market will try to manipulate you in 3 ways. First, it will use vertical candles to trigger FOMO, making you feel like if you don't buy right now, you'll miss the only chance. Second, it will use violent pullbacks to trigger panic, making you feel like you made a mistake and must exit right now. Third, it will use expert narratives to make you outsource your judgment. So you stop tracking the actual mechanisms and start tracking social approval. The antidote is to watch the signal, not the show. Here's a practical way to do that without overcomplicating it. Every day, ask 3 questions. 1. Is the premium staying elevated, rising, or compressing? 2. Is the currency stable or sliding? Because that changes landed costs immediately. 3. Is the policy tone calming the market or feeding uncertainty? If the premium compresses sharply and stays compressed, that's a weakening signal for near-term physical stress. If it stays elevated through volatility, that's confirmation the street is still tight. If the premium rises again after a pullback, that's a loud message. The physical market is defending the move, because if this one level breaks, the math changes. Now let's talk about what comes next, specifically in the next week or 2. The market is staring at a very tight set of catalysts. The budget event is a cliff. Once it passes, uncertainty either resolves or morphs into a different kind of uncertainty. Month-end flows are real, funds and desks adjust exposures, and that can either amplify or temporarily suppress moves depending on positioning. And the delivery and roll mechanics in futures markets can create localized liquidity weirdness. You don't have to memorize contract codes to respect the effect. Near key roll periods, liquidity can change, spreads can shift, and moves can be sharper than people expect. The calendar is the catalyst. So what do you watch on the chart side without pretending we have your exact screen? Watch the last major breakout zone on the benchmark that everyone sees, usually a prior swing high that, once reclaimed, becomes support in a bullish structure. Watch whether pullbacks hold above it. Watch whether rallies are making higher highs without instantly giving them back. And watch the speed of the move. Acceleration without pauses can be powerful, but it also invites violent snapbacks. The market doesn't move in straight lines unless it's in a squeeze. If you see squeeze behavior, fast runs, shallow pullbacks, gaps, that's your warning label. It doesn't mean sell. It means risk can get discontinuous, and discontinuous risk is where emotional decisions get punished. On the physical side, the premium is your best dashboard. If the premium is still near that $8 zone going into and through the budget, that implies the market still expects risk and still values immediate access. If the premium drops hard right before the budget, that could indicate the front run is done and the pipeline is catching up, or that dealers believe policy risk is lower than feared. If the premium spikes again after the budget, that's a different message. Either the policy outcome surprised the market or the funding at currency layer tightened further. That's not the part that matters. The part that matters is how participants are forced to react. If policy comes out supportive, no duty hike, no restriction talk, and the currency stabilizes, you might see a relief rally or a relief pullback depending on positioning. If many participants were long just in case, they might unwind on relief, causing a pullback, even though the medium-term story remains intact. That's why people who confuse good news with up only get blindsided. The market prices expectations, not just outcomes. And if the market was braced for bad news and gets neutral news, the trade can unwind. That's scenario 1 behavior. On the other hand, if policy is perceived as restrictive or inflationary or currency negative, that can feed scenario 2, continued physical bid, persistent premium, and possibly forced buying from shorts or underhedged participants. The difference is in the signal, not the headline. Now, one more mechanism that matters here, especially for anyone who likes the paper can suppress price narrative. There is a limit to how long paper can ignore physical when physical stress becomes persistent and tradable. Not because paper is evil or physical is moral, but because arbitrage and risk management eventually connect them. If physical premiums stay high, physical demand can pull from inventories, which can change availability and hedging behavior, which can show up in spreads, which can eventually influence future structure and positioning. It's not instant, it's not cinematic. It's a slow tightening of constraints that can suddenly look fast when it crosses the threshold. That threshold is often visible first in premiums. That's why this matters. And this is where you should be extra skeptical of anyone offering certainty. When markets are volatile, certainty is a product. People sell it because it feels good. But certainty gets you killed in risk assets. The honest posture is conditional confidence. If the premium stays elevated and policy, not currency risk, persists, the physical signal remains bullish. If the premium collapses and stabilizes low, the physical stress is easing. That's how you keep trust with yourself. That's how you don't get emotionally harvested. So here's your near-term roadmap, clean and concrete. Over the next week, watch whether the premium holds elevated into the budget window. Watch whether the currency continues to pressure landed costs or stabilizes. Watch whether physical availability, dealer quotes, delivery times, and bid-ask spreads tightens further or relaxes. Those are confirmation signals. Watch benchmark price levels around the most obvious prior swing high and the most obvious psychological round number. Markets love those because they're coordination points for human behavior. If price holds above the breakout zone after a pullback, that supports scenario 1 consolidation with bullish structure intact. If price accelerates without allowing pullbacks, especially into thin liquidity, respect scenario 2 squeeze behavior. If price loses the breakout zone and the premium collapses, that's your invalidation signal for the persistent physical stress thesis in the near term. Not forever, near term. And let me say this plainly. You do not have to trade this to use it. You can use it as a macro tell. Silver is a strange metal because it sits at the intersection of monetary psychology and industrial reality. When premiums spike, you're seeing a live experiment in trust, logistics, and policy. We're seeing how quickly the financial world can be forced to acknowledge the physical world. Even if you never touch a contract, understanding that mechanism makes you harder to manipulate. Because here's what's going to happen next in the media cycle, almost guaranteed. If silver rips, the story will be mania, and they'll highlight the most ridiculous voices to discredit the move. If silver drops, the story will be bubble burst, and they'll imply anyone who cared about physical signals was delusional. Both narratives are designed to trigger emotion, not understanding. Your job is to stay anchored to mechanism. Premiums, currency, policy, financing, lead times, positioning, that's the spine. Everything else is noise. Now, a quick reality check for the metals, crowd specifically, the skeptics of institutions. You don't need to claim a grand suppression scheme to respect that incentives can lean towards stability in paper markets. Risk managers prefer orderly markets. Large participants hedge. Liquidity providers manage exposure. Those incentives can dampen moves in the short term. But if the physical market is paying an $8 premium, that's a separate incentive. Someone needs metal now, and they're willing to pay to override the paper calm. That's the tension. And tension resolves. Usually not politely, but that's not the part that matters. The part that matters is what you watch when it resolves. If the premium collapses and stays down, you know this was front-run timing and fear that got satisfied. If the premium stays sticky, you know the pipeline is still constrained by policy, by currency, by funding, by logistics, or by a combination. And if the premium expands again after the policy event, that's a loud message that something tightened, not loosened. That's your hidden detail made visible. So if you've been looking for the one metric everyone must watch, here it is. The premium relative to the benchmark, tracked through the budget window and the following week. The benchmark price will move. It always moves. But the premium tells you whether the move is being validated or rejected by real-world access and urgency. And when that premium is extreme, it's telling you something about stress that won't show up in a tidy headline. That's why the spread is telling the truth. And here's the subtle community thing, because it matters. If you're the kind of investor who wants mechanisms, not mood swings, if you want to understand what markets are forcing people to do, not what someone is trying to make you feel, then you are already ahead of most of the crowd. Stay in that lane, track the signal, ignore the theatrics. And remember, even when you're right on the thesis, the market can still try to shake you off the trade through volatility. That's how it transfers conviction from weak hands to strong hands. In the next week or two, we'll find out which scenario we're in. Either the premium compresses, the market digests, and we get a controlled retest that cleans out the emotional buyers, or the premium stays stubborn. Policy and currency pressures don't give relief, and the move stays in squeeze mode where liquidity thins and gaps become a real risk. Don't predict it, measure it. Because when you measure it, the market can't gaslight you. And if you remember nothing else, remember this. The headline price is the polite version, but the physical premium is the argument happening underneath. Watch the argument. That's where the next move is born.